Hello, First Quantum Leader, and welcome to the third unit of understanding the elements of the balance sheet. Today we'll be looking at two more sections of the balance sheet, being the current assets and the current liabilities. In the last unit, your task was to identify suppliers and how they're funded. How did you get on? Suppliers who are manufacturing goods are more likely to have debt on their balance sheets than consultants who are supplying their services. In the first unit, we looked at an overview of the balance sheet, and in the second unit, we examined where capital comes from, debt and equity, which appear as non-current liabilities and equity in the balance sheet. In this third unit, we'll be focusing on two more sections of the balance sheet, current assets and current liabilities. At the end of this unit, I'm going to ask you to, in the next week, find out the payment terms for 5 suppliers to First Quantum. I hope you remember that current assets are things we own, assets, which are either cash or going to become cash quite soon. Aside from cash, the other two main types of current assets are inventory, stock in the warehouse, and trade receivables, sometimes called trade debtors, being organizations to whom we have sold our product, but they have not yet paid. You may also remember that current liabilities are things that we owe and have to pay soon. And by soon, we mean within 12 months of the balance sheet date. For First Quantum, the current assets are $3.2 billion and the current liabilities are $2.5 billion. If we compare the current assets to current liabilities, i.e. $3.2 billion divided by $2.5 billion, we end up with a ratio of 1.28. This ratio says that for every $1 we owe and have to pay soon, we have $1.28 either as cash or coming in as cash soon. Have a think about that for a second. That sounds pretty good, doesn't it? It means that we have more cash coming into the business than is going out. That has to be a good thing. If this ratio were less than 1, i.e. if the current assets were less than the current liabilities, then we might end up owing and have to pay soon more than we had as cash or coming in as cash. What we are looking at here is the current ratio. This current ratio is assessing the liquidity of the company. The liquidity of the company is the ability of the company to pay its financial obligations as they fall due. Another way of saying, can you pay your bills on time? We might also want to run exactly the same calculation, only this time eliminating the stock figure. This is known as the acid test or quick ratio and measures a company's ability to meet its financial obligations without the need to sell its inventories. First Quantum's inventories are $1.4 billion, so the current assets without inventory is $1.8 billion. Comparing this $1.8 billion to the current liabilities of $2.5 billion gives us a ratio of 0.72. This does not look too good on the face of it. Remember, whenever we calculate a ratio, it never gives us the answer. It merely indicates areas that might need further investigation. A couple of things spring to mind. One, First Quantum is selling a commodity, so it's very easy to sell, not like Persian carpets, for example. So it's okay for the company to feel comfortable that it will be able to sell its inventory reasonably easily. Two, in the current liabilities, there's an amount of current debt of $838 million. This is the current portion of long-term debt, i.e. the long-term debt that was raised to buy the plant and machinery and just happens to be repaid in the next 12 months. However, if you remember in the last unit, we discussed how First Quantum has a tendency to roll over or refinance its debt rather than repay it. So First Quantum is not going to have to use its current assets to repay the $838 million, but rather it will take out another loan to repay it. We can therefore remove the $838 million from the calculation. This will give us current assets, net of inventories, of $1.8 billion and current liabilities, ignoring the debt, of $1.7 billion, a ratio of 1.06, which is much more comfortable for us. The current assets and current liabilities taken together are known as the working capital. That working capital can be considered as the oil in the engine of the business and is essential to keeping the lights on and everything working. This is a very important part of the balance sheet and one that we can all influence directly. So in Unit 2, we looked at the sources of capital, debt and equity, and in this unit we've looked at one of the applications of that capital, that of working capital. Working capital is essential to the liquidity of the company. If First Quantum runs out of cash, it will not be able to pay its staff. If you are not paid this month, then you will not turn up to work next month. Luckily, the finance guys at First Quantum are very good at managing cash and everything looks good. So, the current assets are things that we own and are trying to turn into cash or already are cash, while current liabilities are things that we owe and need to pay soon. Comparing these two numbers examines whether we are able to meet our financial obligations as they fall due. Another way of asking whether we can pay our bills on time. We can improve our cash flow by A, shifting inventory as quickly as possible, B, collecting amounts owing as soon as possible, and C, paying our suppliers as late as possible, but not too late. So on to your task for today. In the next week, find out the payment terms for 5 suppliers to First Quantum. In the next unit, we'll be looking at the non-current assets. Looking forward to seeing you then.